Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 4th of September, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Well, there's a lot happening in the market today. Too much bad news. The economy is definitely slowing. The ASX is down 2% or 169 points. The economy is growing at the slowest rate since the early 1990s. This is less than 1% on an annualized basis. For the quarter, it was 0.2%. However, spending by households is negative. On a per capita basis, the economy is going backwards. Investors right now is taking risk off. Long term, as always, things will be okay. Just right now, if you're a short-term trader, you need to be aware that there's economic problems going forward right now, and the RBA cutting rates, it will be in the headlines for the next couple of weeks. Here's some interesting news that I wanted to share with you for those of you who are going to fly either domestically or overseas. MIT came out with a study recently talking about the risk of flying on a per passenger basis. In 2022, there was one death per 13.7 million passengers. In 2007, one death per 2.7 million passengers. And going back to 1987, there was one death per 750,000 passengers. Even though Boeing has problems with the 737 MAX, the risks are still extremely small and getting better. Now, there's also a caveat here that flying is categorized into three different zones. One is developed countries, two is moderate, and then three is third world countries. In developed countries like Australia, United States, Europe, the death rate is only one death per 80 million passengers. Thus, walking across the street is dramatically more risky than hopping on a plane. Four companies I want to cover today. The first one is Mineral Resources. The code is MIN on the ASX and it's trading at $35.04. This is a 5-year chart. Past couple of years have been difficult for them. Let's look at the numbers. These are estimates from Macquarie. Currently, MIN has a market cap of $8 billion. Macquarie has a price target of $48, which is higher than the current price. The revenue growth rate from 2024 to 2026 is negative 7.5% per annum. The earnings growth they estimate is a huge 70%, but that is deceptive because they're expecting earnings in 2025 to be terrible and then pick up in 2026. The reality is you can't go by that growth number. The dividend growth is also up decently, 20%, but it's a low base also. The PE on the 2026 earnings estimate of $2.44 is 14.3 times. That makes the stock a little bit expensive, even at $35. The yield on the 2026 dividend estimate of 29 cents is less than 1%. The shareholder equity has been going negative recently, but is now starting to turn and become positive, although at a low rate. MIN is involved in iron ore and lithium. Obviously, lithium has had troubles because of excess supply globally. If you remember, back in August of 2023, I recommended going short MIN when it was over $67. Currently, I would say that it's probably getting close to bottoming out. I would cover half the short. Otherwise, I'd rate it a neutral company at this stage. Woolworths Group. I include this because it's always an important company in the earnings season. The code is WOW on the ASX. It's currently trading at $34.26. Looking at this 5-year chart, it is a very volatile company in terms of price action. The business itself is not all that volatile. So this gives you an opportunity that if you wanted to sell volatility, call options against your shares, you would get a lot of extra income simply because it is more volatile than it should be price-wise. Now, these are Citibank estimates. I like Citibank because they have a very strong analyst in retail and supermarket sector. Market cap for Woolies is $45 billion. Citibank has a 12-month price target of $39. That is like $5 above the current price. Revenue growth of 2024 to 2026 is only 3.6%. That is, considering inflation and population growth rate, a negative number if you adjust for that. Earnings per share growth in this period is 4.9%. Well, that's just a touch above inflation, so it is positive, but not all that great. The dividend growth rate is 5%. So it is growing, just not very fast. The PE on Citi's 2026 earnings estimate of $1.54 is 22 times. That's a little bit high for a company growing at a slow rate like this. The yield on the 2026 dividend of $1.15 is only 3.35%. Woolies doesn't really have a yield to keep the stock price up. The free cash flow is estimated around 5%, and the payout ratio is 75%. So as we expect, it's the largest supermarket chain in Australia. It has excellent management, except they've peaked on their market share capability. I rate it neutral. While it's a good company, because of butting up against the wall with market share, it's struggling to have growth. Third company today is Wesfarmers. The code on the ASX is WES. It's trading at $70.10. This is a 5-year chart. It has performed extremely well the past 2 years. However, again, let's look at what the fundamental numbers tell us. These estimates are by Citibank again. Market cap is $84 billion, so it's one of our larger companies. 12-month price target, they have $61. Well, it's trading at 70. The revenue growth rate from 2024 to 2027 is 3.8% per annum. And the earnings growth is 7.8%, and the dividend growth is 9.2%. The PE on 2026 earnings estimate of $2.58 is 27 times. That's a pretty high PE. The yield on the 2026 dividend estimate of $2.36 is 3.4%. That's an okay yield. Free cash flow is 4%. Payout ratio is a large 91%. I'm not concerned about that payout ratio because they always have a high payout ratio and they always seem to do well in terms of growing their company. As you probably know, Wesfarmers owns Bunnings, Big W, petrol stations, office works, and various chemicals, fertilizers, and industrial safety products. This is also a solid company. However, it's way overpriced. I rate it a sell short term. When it drops, I'd then buy it because it's a good long-term company. Qantas Airways. QAN is the code on the ASX and it's trading at $6.77. I've been pretty bullish on this, and for a while I was being proven wrong. However, it is now solidly over $6. It's $6.77. Let's look at the numbers. Citi estimates again. The market cap is $10 billion. 12-month price target they have is $6.60. So it's just shot past that price target. Revenue growth for each of the next 3 years is estimated only 3.6% per annum. And the earnings growth is 9.5%, and the dividend growth is 8.0%. These are all solid numbers. Airlines are a tough business to be in, but Qantas always seems to do well. The PE on the 2026 earnings estimate of $1.07 is 6.3 times. This is cheap. Qantas always trades cheap though. And there's a lot of reasons to it. One is they don't own many assets. They lease everything. It's a total cash flow business. And they have a lot of expenses and a lot of employment, a lot of maintenance. The yield on the 2026 dividend estimate of 35.5 cents is 5.2%. So that's attractive and will keep the price up as long as they can maintain it. Problem I see here is free cash flow is only 1%. Payout ratio is 31%, which is good because it gives them retained earnings in reserve. They can raise their dividend if they need to or apply it for growth. Qantas is a domestic international airline. 2/3 of its earnings is from domestic travel. 10 years ago, 20 years ago, it used to be reversed. International routes was a big profit center. The brands include Jetstar. I rated a buy half weight. And if you really push me, I'd be more neutral. However, I have faith in Qantas. It doesn't have all that much competition. As always, if you want to learn anything more about things I covered today, send an email request to stockwatch@fnn.com.au and direct your questions to me, Chris Pedersen. I hope the market turns around and ends up by the end of the week.